Good morning. Ladies and gentlemen, it's a real pleasure for me to welcome you all to this fifth biannual conference on financial stability, a conference that is jointly organized by the Banco de España and the Centro de Estudios Monetarios y Financieros, CENFI. The first edition of this conference was held in 2017, just 8 years ago, and yet it has become a well-established event in our calendar. Over the course of today and tomorrow, a total of 37 speakers with diverse backgrounds and coming from more than 20 institutions and universities will discuss both the theoretical and also the empirical aspects of some of the most pressing and emerging issues in financial stability and macroprudential policy. As in previous editions, 12 working papers will be presented and discussed. These papers were carefully selected from over 140 submissions received in response to our call for papers. And this would have not been possible without the work of the scientific committee, co-chaired by Rafael Repullo from CENFI, who has co-led this conference since its inception, if I'm not mistaken, and Galo Nuño from Banco de España. I would like to sincerely thank both of them, as well as all the other colleagues involved in organizing this event for their dedication and efforts. This year's topics are wide-ranging, from the implications of interest rate risk to the bank lending channel of monetary policy, the link between credit and climate risk, and the implementation of the countercyclical capital buffer, to name just a few. This afternoon, we will have the honor of welcoming Professor Thomas Philippon, who will deliver a keynote speech on stress testing, an issue of great economic and regulatory relevance. And the conference will conclude tomorrow with a policy panel focused on housing risk and macroprudential measures, specifically on the design and the implementation of the borrower-based tools. The panel will be moderated by Professor Javier Suarez from CENFI and will feature several distinguished experts. I think we can say that this conference is always privileged to host an exceptional lineup of keynote speakers. And today, we have the honor of welcoming Governor Klaas Knot, who will open the conference with his remarks. And this will be followed by a dialogue between Klaas Knot and José Luis Escrivá, Governor of the Banco de España, moderated by myself. Klaas Knot needs no introduction, but, of course, I'm going to introduce him. He is about to complete his second and final 7-year term as president of the Netherlands Bank and has simultaneously served as president of the Dutch Financial Stability Committee, vice chair of the Financial Stability Board between 2018 and 2021, and since then, chair of the Financial Stability Board until the end of this month. He has a distinguished public service career as an economist, which spans more than 3 decades. With increasing responsibilities in several authorities, such as the IMF, the Netherlands Bank, the Dutch Pension and Insurance Authority, and the Dutch Ministry of Finance. But it is in his capacity as FSB chair that he is in Madrid this week, on the occasion precisely of the plenary meeting held yesterday here at this venue, and it has been an honor for us to host this important event. Yesterday marked his final meeting as chairman of the Financial Stability Board. And Klaas' leadership at the FSB has been instrumental in advancing its core mission, which is promoting international financial stability, not an easy task, as we all know. During his tenure, he has led FSB through the final stages of the pandemic and then through a period of financial volatility, geopolitical tensions, and rapid technological change. And very briefly, some of the key achievements under his leadership include a number of policy recommendations in the field of non-bank financial intermediation, the global regulatory framework for crypto asset activities and global stablecoins, recommendations to enhance convergence in cyber incident reporting, or significant progress to improve the efficiency, accessibility, and transparency of cross-border payments, among others. I would also like to highlight his coordination efforts with other standard-setting bodies such as IOSCO and work on climate-related financial risk and support to the implementation of climate disclosure standards. Similarly, his leadership at the Netherlands Bank has been widely recognized, particularly for its contribution to financial stability analysis and macroprudential policy, precisely the core themes of this conference. So without further ado, I will now invite Governor Knot to deliver his speech from this lectern and then join Governor Escrivá for a dialogue on current policy issues. Governor, the floor is yours.
So that was quite an introduction, I must say. Good morning to all of you, and thank you very much for having me here in Madrid. And I want to talk with you about how is the water continuing our work to preserve financial stability. And in order to sort of make the link between the title and what I'm about to say, I want to start by telling you a little story. And some of you may actually know it. It's a story about these two young fish swimming along, and then they happen to meet an older fish swimming in the other direction. And the older fish then nods at them and says, "Morning, boys, how is the water?" The two young fish, they swim along for a bit, and then eventually one of them looks over to the other and says, "What the hell is water?" Well, this parable was famously used by the American writer David Foster Wallace in a commencement speech in 2005. Now, just like Wallace, I don't plan to present myself here as the wise older fish explaining to you what water is. But the point of the story, the point of the fish story, is merely that, like he said, the most obvious, important realities are often the ones that are the hardest to see and to talk about. Now, Wallace was speaking to a class of graduates about the benefits of a liberal arts education in life. To have his idea being used by some central bank technocrat at a conference on financial stability would probably have been his worst nightmare come true. But although it may seem a bit of a stretch, I believe that this idea applies to our world as well, because financial stability is an obvious and important reality, because its impact is universal. Financial stability affects households, businesses, governments, and ultimately the trust that underpins our economies. It's the basis of basically everything in economic life. And because of its universal impact, financial stability seems like a natural state. We take out our phone and we pay. And the bread that we buy costs roughly the same as it did last week. And when we wake up in the morning, our savings in the bank are still there. Financial stability is something that seems to be just there, unconditionally. But it really isn't. It's something that we must continuously work for. It demands vigilance, coordination, and above all, a political will to act before the crisis hits. Now, I know that you are aware of this, but many people tend to forget. And as this is my last address in my capacity as chair of the FSB, let me take this opportunity to look back a bit and to take stock, and to ask ourselves, where do we stand? How is the water? In truth, it has been anything but calm. Over the past years, we've experienced quite some waves in the financial system. The dash for cash during the onset of the COVID pandemic. The commodity markets turmoil following the Russians' invasion in Ukraine. The failure of Archegos capital management in March 2021. And the market volatility associated with the recent trade tariff announcements. Central banks had to intervene in some of these episodes to support market functioning and the supply of credit to the real economy. And in each case, parts of the non-bank financial sector played a central role in amplifying the stress. Non-bank financial intermediation, or NBFI in short, has grown into a critical part of the financial system. Its rise has been driven by regulatory shifts, by a search for yield, by technological innovation, and demographic trends leading to asset accumulation. The NBFI sector brings some real benefits. It offers a diversified source of funding and much-needed competition for the banks. But they also bring their own set of vulnerabilities, liquidity mismatches, and the inability of some market players to prepare for them, leverage, and growing interconnectedness with the banks. Historically, regulation of this sector focused on investor protection, on market integrity, and other mandates. But those don't fully capture systemic risks. So we also need a financial stability lens. And that is what the FSB has brought to the table. Our work to date has included policy recommendations to enhance money market fund resilience, to address structural liquidity mismatch in open-ended funds, and to enhance liquidity preparedness for margin calls. Later this month, we will deliver policy recommendations to the G20 to address financial stability risks from leverage in NBFI. Now, a fair question to ask is, have we made a difference? The recent bout of tariff-related volatility in global markets could serve as a test. We saw a global sell-off in equity markets and historic trading volumes. Typical correlations between certain asset classes broke down. We saw some deleveraging, and we saw large margin and collateral calls. Yet, the system held, and that's encouraging. But let's be honest also here, we can't credit our reforms just yet, because the FSB's recommendations have not yet been implemented in full. And recommendations alone don't reduce systemic risk. Implementation does. So that means that authorities must not only put them into national laws and regulations, they must also have the capacity to operationalize them. And one of the biggest challenges that we face here is NBFI data. We need better data. We need more data, but above all, we need better use of data. There is a reason why the non-bank sector was formerly called shadow banking. It is opaque. There are gaps. And those gaps means that we often don't see the vulnerabilities until it's too late. The quality and timeliness of non-bank data are essential for identifying and assessing vulnerabilities and for designing and calibrating effective policies. We must address these data challenges. We can't keep relying on crisis to reveal what we should have seen coming. That's why a high-level group within the FSB is now exploring how to close such data gaps, to support risk monitoring, policy design and implementation, and cross-border cooperation. And let's be clear, we can't just copy-paste banking rules onto the NBFI sector. It is too diverse and it's too different from the banks. We need to look at both non-bank entities and activities. But our goal should be clear: a level playing field across the financial system. Not by weakening the bank rules, but rather by strengthening the resilience of the non-bank sector. Which brings me also to the banking sector. During my tenure as FSB chair, we witnessed something unprecedented, which was the failure of a global, systemically important bank. The demise of Credit Suisse, together with the failure of 3 US regional banks, was a stark reminder that bank failures are not just relics of the past. It brought lessons for banks and financial authorities. In some areas, our work to make the banking sector more resilient is not yet complete. Take the final Basel III standards. These are designed to strengthen the resilience of banks to withstand losses. And yet, they still have not been implemented in many, many jurisdictions. The Credit Suisse case also highlighted that more than 15 years after the global financial crisis, authorities still face challenges in dealing with failing banks. So yes, we have made progress, but we're not done. And in the meantime, of course, we must protect what we have built. Because let's not forget, during all the recent episodes of financial stress, the banking system held up relatively well. In fact, during the pandemic, banks acted as a shock absorber, not as a shock amplifier. They absorbed losses, they kept credit flowing, they helped the economy afloat, or to keep the economy afloat. And that is no small feat. And I believe that that is largely thanks to the reforms that we put in place after the global financial crisis. The years of hard work, the years of tough decisions, the commitment to resilience. But now, more than 15 years later, we are hearing familiar calls again. Calls for deregulation, but also calls for simplification. And let me be clear, those are not the same. I understand the desire to simplify. Banking regulation and supervision has become overly complex. Over the past 15 years, a great deal of regulation has been introduced from various angles. From global, EU, national angles, micro versus macro angles. New risks were added to the plate, old ones were rarely removed. There is some overlap here and there is some friction here and there. And yes, sometimes there's also a lack of supervisory proportionality for smaller institutions. And that is all worth looking into. But keep in mind that beyond some point, simple rules are less risk sensitive. And that means that they have to be stricter. You want simpler rules? Sure. But those rules must then be calibrated at a more prudent level. That's the general thinking behind the standardized approach of Basel III. That's also the thinking behind the leverage ratio. Most importantly, what we must avoid is confusing simplification with deregulation. Deregulation effectively means lowering buffers by relaxing the rules. And that would both reduce resilience in the banking system and increase the likelihood of future financial crises. We cannot afford to undo the progress that we have made, especially not now, in this time of unusually high uncertainty, both on the economic and on the political front. That would be a big mistake. As the late Rüdiger Dornbusch used to say, the crisis takes a much longer time coming than you think, and then it happens much faster than you would have thought. Which brings me to my next point. The developments in both the bank and the non-bank sector are unfolding against a backdrop of major structural shifts. Shifts that could reshape financial stability as we know it. I'm here talking about technology, about payments, and about climate risk. Technological innovation is transforming the financial sector. It is adding new layers of complexity, and it is doing so at speed. The period leading up to the 2008 global financial crisis was marked by balance sheet expansion and financial product innovation. But over the past 15 years, the focus has shifted toward technological innovation. And the FSB has been watching this closely. It is our job to harness the benefits while mitigating the risks. And yes, also here, the benefits are real. Technology has made financial services faster, more accessible, more inclusive, and more efficient. And in some areas, like in the area of AI, we have only started to see its full impact. But it also brings new risks. Why? Because of the speed and scale of adoption. For example, in cyber attacks, because of growing interconnections with the traditional financial system, because of concentration in services in a few key providers. Technology creates new interdependencies, and it can accelerate the pace at which a crisis unfolds. Technological innovation is perhaps most visible in the payments space, where new platforms and digital assets are rapidly reshaping how value moves across borders and between users. These dynamics are most visible in crypto assets. This fast-growing market has seen more than its fair share of bankruptcies, of liquidity crises, and outright fraud even as its links with the traditional finance continue to grow. At the FSB, we have long maintained that crypto does not yet pose a systemic risk. But recent developments suggest that we may be approaching a tipping point here. Barriers for retail users have dropped significantly, particularly with the introduction of crypto ETFs. And the interlinkages with the traditional financial system continue to grow. Stablecoin issuers, for example, now hold substantial amounts of US treasuries. And that is a segment that we clearly must monitor closely. The crypto ecosystem will continue to evolve, and so must our regulatory frameworks. Jurisdictions are actively developing these, and the FSB's recommendations form a common foundation. This is especially important given the inherently cross-border nature of crypto. Effective implementation must also extend beyond the G20, supported by strong regulatory and supervisory cooperation. Now, part of the crypto's rise can be traced to the shortcomings of traditional cross-border payments. And this is a very complex technical issue. But solving it has real-world benefits for people, for businesses, and for economies. And that's the goal of the G20 roadmap for enhancing cross-border payments. The aim of the roadmap is to bring about cheaper, faster, and more transparent and more inclusive cross-border payment services for the benefits of citizens and businesses worldwide. Also here, we have made progress. The FSB, the CPMI, and others have done a lot of work. Our goals, however, are quite ambitious. And while they have driven changes by both the private and the public sectors, we continue to see significant challenges, particularly in certain regions and certain payment corridors. As we move toward crafting a strategy for the next phase of work, we are seeking to clarify the issues that continue to impede progress, and we will continue to work with the private sector to get it done. Next to technology and payments, we face another growing challenge, one that is no longer on the horizon, but it's right at our doorstep. And here I'm talking about the challenges related to climate change. Now, climate change may have originated outside the financial sector, but its impact on financial stability is very real. Extreme weather events are becoming more and more frequent. And as they occur, the risks to financial systems continue to rise. These events test the ability of financial institutions to manage risks and to maintain services, especially in the most vulnerable regions. And that is why we must keep strengthening risk management practices. And that is why we must continue to build resilience across the entire global financial system. The FSB's climate roadmap, launched in 2021 and endorsed by the G20, gives us a coordinated path forward. It focuses on 4 key areas: firm-level disclosures, data, vulnerability analysis, and regulatory and supervisory tools. These 4 pillars are not standalone. They are connected and they build on each other. For example, we need consistent and reliable corporate disclosures as a foundation to close some of the data gaps. They help firms and authorities to better understand climate-related financial risks. Better data leads to better analysis. And better analysis leads to better policy. And also here, we are making progress. More jurisdictions and companies are adopting climate-related disclosures. New global standards on sustainability assurance are boosting trust in those disclosures. And tools like climate risk dashboards and scenario analyses help us to understand the inherent vulnerabilities. International bodies are issuing guidance on how to integrate climate risks into existing regulatory and supervisory frameworks, and good practices are being identified. Across the globe, the global financial community shares knowledge and shares good practices here. But let's be honest, challenges remain, especially when it comes to implementation. The groundwork is there, but now the focus must shift to action. Action by firms, action by authorities. We still lack reliable, granular, and comparable data. And that makes it hard to fully assess and manage climate-related financial risks. And let's also face it, traditional financial stability tools weren't built for this. They're not always fit for purpose when it comes to forward-looking, long-horizon risks like those related to climate change. And that's why developing robust, climate-specific analytical approaches must remain a top priority. Because climate risk isn't just an environmental issue. It increasingly is also a financial one. And it's one that we can't afford to ignore. Now let me wrap up. Financial stability is an international public good. Every single issue that I've mentioned today, be it NBFI, banking, crypto, payments, climate, they all cross borders. And so must be our response. If we want to meet today's challenges to financial stability, we have to continue to work together. And we need to stay committed to the international bodies that we build to underpin such cooperation. For example, the Basel Committee and also the Financial Stability Board. In a fragmented world, global cooperation is harder, but it is also more essential. During the global financial crisis, policymakers acted swiftly and they acted in unison. We must preserve that capacity. Because for society, financial stability is like what water is for the fish. We barely notice it until it's gone. Preserving financial stability requires continuous hard work. It is complicated. It's technical. It's not glamorous. Calibrating risk weights for banks doesn't make headlines. It doesn't fill the streets with protesters and the like. But therefore also, it doesn't always get the attention that it deserves from policymakers among all the other issues that they have on their plate. But make no mistake here. A stable financial system is the foundation for almost all public policy. When financial stability is lost, everything else falls apart. Governments can't focus on education or healthcare or climate. They're too busy drawing up rescue plans for an economy in free fall. So we have to continue our work, which means maintaining our ambition as policymakers to take the agreed policies all the way through to implementation. So let's keep our eyes on the water and let's keep it safe and stable. I thank you very much for your attention.
Enough time to touch upon several topics. Let me just start as a follow-up of your intervention, Governor, just continuing with some of the messages that you just said, because definitely you mentioned a lot of areas that deserve further attention. You mentioned NBFI, recognizing that it's a quite diverse sector. You mentioned as well the current debate between simplification and deregulation, the technology and the challenges coming from crypto assets. We can come back to this later. But considering your past experience, your background, not only as as the Financial Stability Board, but also 14 years as president of the Netherlands. You also have been very much involved in the Basel Committee. Let me just ask a general question on which lessons would you like to emphasize for the future to come, or where do you think we should focus more? You know, where do you think we should be the greater focus?
I hoped that I already
Yes.
drew some of my lessons at the podium there. No, if I try to perhaps summarize it in one sort of catch-all word, then I would opt for the word diversity. Diversity both in the financial system. As a central banker, you're typically mostly focused on banks, because that's closest to sort of the monetary transmission process, etc. So in the past, I was also quite heavily involved in banking regulation, the whole Basel world, etc. Through the FSB, I became more and more involved in the non-banks sector, and that's an enormously diverse set of institutions. So the whole concept of resilience in the non-bank area is much more diverse than the concept of resilience in banks, which is basically about capital and liquidity buffers. But, well, in NBFI, it's such a heterogeneous space that diversity is really something that you have to keep in mind. And diversity I can also use in terms of the membership. Because we are, most of us are coming from advanced economies, but I think the strength that I also discovered while being active in the Financial Stability Board, while chairing this Financial Stability Board, is actually in the diversity of its membership. So it's a G20 plus committee. We have representatives both from the advanced world, but also from the emerging markets and developing economies. And as a matter of fact, during my tenure, I have tried to sort of be inclusive and reach out a little bit more to that part of the world as well. And I think it has greatly enriched some of our discussions. For instance, on crypto assets and on stablecoins, most of the emerging markets and developing economies are completely on the receiving end of what happens in other countries. And there are serious issues about loss of monetary sovereignty in the developing world, etc. And I think that has, the debate at the FSB table has benefited greatly from diversity. I know it's a word that on the other side of the Atlantic is no longer as permissible, but luckily we are in Europe here, so that would be my central theme.
Perfect. I think that precisely this is why it's important also to highlight this word, no? The diversity. So, Governor Escrivá.
May I say something
yes,
on this?
Ahead.
Because to me, what Klaas was indicating give rise to the following reflection. I mean, over time, and particularly from central banks and bank regulators, we have realized the importance to strengthen standards and overall regulation. But here the risk is that there is a sort of regulatory arbitrage, both cross-border, but also even within some jurisdictions. So to the extent that we strengthen the standards and the regulation for the core of the financial system, namely the banks, the risk is that other parts of the system are benefiting in terms of lower standards and become more risky and more relevant over time. So that's the reason why an institution like the Financial Stability Board is so necessary to encompass all the regulators and supervisors of the financial system and to try to have a comprehensive view about how this risk may evolve between institutions, between jurisdictions, and try to really avoid that this regulatory arbitrage is moving in the wrong direction.
Totally right. The importance of this international cooperation and avoiding or ensuring the level playing field. So I was going to move moving on to macroprudential framework, and the question to you, Governor, is related to precisely to the available toolkit that we have as authorities to address macroprudential risks, because we know that macroprudential risks are quite diverse. We can say that it is multidimensional because systemic risk has many different phases. And as authorities, we have different type of tools, the ones that we call the capital-based tools, such as countercyclical capital buffer, the systemic risk buffers, but we also have the so-called borrower-based instruments. And we have seen some European countries have introduced in the area of the countercyclical capital buffers, they introduced the idea of positive neutral, others are also experiencing the deployment of the borrower-based measures. So, Governor Escrivá, what are the advances here at Banco de España in the development of its macroprudential toolkit, and how do you see this area evolving in the near future?
Well, that's a crucial issue to us because Spain is a country that, given our experience, past experience, we know very well that lending can be extremely procyclical, leverage can be very procyclical, and then we also know from the past that we lack instruments. We as macroprudential authorities, we lacked in the past the instruments to be able to smoothen this cycle and to avoid both financial stability disruptions, but also macroeconomic ones and the impact on the entire economy. So our history is very telling in this respect. It's not surprising that in the Spanish case, the legislator gave us, to the Bank of Spain, ample room for activating macroprudential tools. It is the countercyclical buffer. We have decided to do so in a gradual manner, up to 1%, and over a period of 2 years, and we are in the middle of the process of that. This process of endowing this fund will end up by the fall of 2026. But of course, the capital is a non-target instrument. That's the reason why borrower-based measures, setting limits to lending standards is also a very important tool when the problems are in particular instruments, lending instruments with particular ways of expanding credit more than probably this advisable. Here, we are at the following point. We feel, as in the same we have applied to the countercyclical buffer, is that we have to activate and to deploy the instruments in normal times, or at least not when we are already close to a very strong dynamic in credit in these boom and bust cycles. That's the reason we activated already the cyclical buffer, and that's what we are thinking about the borrower-based measures. In Spain, because of the extremely the high amplification of the previous credit cycle, we started from a very low credit level, so the cycle is a long one. So we are still in the middle, probably. This is difficult to judge sometimes, but we feel that we are in the middle of the cycle. So it's time, and that's what we are working on now, to start first thinking of the metrics that we have to use and the particular type of standards we have to affect in credit, in lending, and this requires a strong analytical work that we are undertaking at present, and when this is completed, it will be the time to decide what instruments should be first employed, and second, what should be the thresholds to be used. And that's something that requires thorough analysis, and we have already told the banking institutions in Spain that we are working on that. It has been also been reflected in a recent financial stability report, and I think this is a priority in the work of the Direction General of Financial Stability Regulation and Resolution. So certainly this is very important to us, and we are hands-on.
Thank you. You mentioned, yes, because you mentioned timing. No? I will particularly ask Governor Knott, because you also have your appraisal on the use of these measures, the borrower-based measures, and also you have experience in your own country.
Yeah, what I would say conceptually, if you think about macroprudential measures, you can draw a distinction between, on the one hand, those measures that are meant to prevent the build-up of vulnerabilities in your economy, in your credit cycle, etc., and those macroprudential instruments that are meant to increase the resilience of the financial system in situations in which, unfortunately, these vulnerabilities begin to manifest themselves. And if you then look into our toolbox, one easy conclusion is that we have many, many more tools in the second category, i.e. strengthening resilience predominantly in the banking sector, counter-cyclical buffers, systemic risk buffers, sectoral risk weights, and what have you. And we don't have too many instruments that sort of are there to prevent the buildup of vulnerabilities, because these instruments are much more intrusive into other parts of economic life. Take the borrower-based measures, increasing loan-to-value or loan-to-income. Of course, I mean, from a theoretical perspective, that's what you should do if you fear that the credit cycle is getting out of hand. But hey, what does it mean if you tighten loan-to-value, loan-to-income measures? Essentially, you're telling young couples in the economy, you wanted to buy your first house? Sorry, you have to wait a few years longer because we make borrowing more difficult for you. Most macroprudential measures are of the type increasing borrowing cost without increasing borrowing cost. So indirect, making borrowing more difficult without sort of changing interest rates. And of course, then you bump into other public policy objectives, and that has also been the tension in the Netherlands. Why, for instance, despite the fact that year after year the IMF is advising us that the loan-to-value and the loan-to-income measures should be in the toolbox of the central bank, the Ministry of Finance is not willing to give up its competence in this area, because it maintains that, of course, activating these instruments requires a trade-off. It has a trade-off between financial stability and between accessibility of the housing market. And these are two conflicting public policy goals. And that's, I think, an illustration why these instruments of the first kind are much more complicated than the ones strengthening resilience in the banking sector.
Oh, definitely. You raise the concept of the governance of these measures. I think it's quite relevant, precisely because of the conflict of interest that may appear. So if that's okay, let's move on to stress testing, because this will be a question to both of you, and I will start, if that's okay with you, Governor Escrivá. We know the stress testing tools have emerged as a key policy tool to use or to assess the resilience of the banking sector, particularly after the great financial crisis. But however, since then, we can say that the economy has changed, the financial system has evolved significantly, and we live now in a more volatile and unpredictable environment. And additionally, I don't know, through the years, there may be some aspects of the methodology that could be further improved. So, Governor Escrivá, what's your appraisal on the current stress test practices here in Europe?
Okay, I was actually involved around 15 years ago when the stress test started to be designed and used for micro and macroprudential purposes. And now I have come back to, after doing a number of other things, and so I have some perspective. And I would say that we started designing the instrument and using it with, let's say, ambition. But when I now look what we are 15 years later, I would say there is still room for being more ambitious and to continue progressing in the way we deploy the instrument. And I'm going to refer to two things here. One is the methodology that we used and the analytical background. I think this contains important econometric modeling. Seems to me that when on monetary policy we have made substantial progress in the way we use models in a robust and we rely on the state-of-the-art modeling. the instrument that we use in Europe and Europe in general, I mean, for stress tests is not as close to the state of the art as is in monetary policy. So there is room for enhancing how we use it. Also, I think we tend to rely too much on inputs that come from the institutions, from the banks, particularly for the pre-provision profit. And I think that it would be desirable to, and I think this is the case, for instance, in the United States, that they really have gone further in having the capacity internally in the central bank to produce itself pre-provision profits. This also would allow to a further enhancement is not to have static balance sheets for the exercise. So there are here, these are just examples of areas which I think we should continue making progress. And the reason for that is because I do believe that stress tests can be a very powerful exercise. Yeah. Not only, but we need to be more comfortable with how we do it in order to go further. Here in Europe, we tend to use it primarily from the EBA exercise every 2 years, which is public and it's linked to, let's say, to Pillar 2 capital requirements. I think that there are other uses which might be very important, primarily for macroprudential, because you do it at the micro level, but by aggregating all the data, you have a macro analysis, and here you can have more, let's say, scenarios for stressing than the one we used at present. Could be a variety of scenarios. And I would say that also we could use it by looking at certain part of the system or group of banks, group of institutions in a more agile world. It would be more an internal work in our assessment of vulnerabilities. And so I see a lot of potential in doing so. But we have to work on both directions, on the methods to be used and how we employ it flexibly at the national level, at the European level, at the micro level, and at the macro level.
And the need to develop this capacity as well. Yeah, no, very important. How do you see that? What would be your insight on stress testing design?
Yeah, I would sort of center my comments around the concept of agility. I mean, I already illustrated that over the last few years we've seen a couple of unprecedented shocks, and also the frequency of these shocks seems to go up. And that means that you have to have a tool that is nimble in the sense that can adjust very quickly to run additional scenarios, which we do also in macroeconomic forecasting, but then to also prepare the banks for the possibility of different scenarios evolving. That means you have to make sure that stress testing, which I agree is a very, very important tool, it's probably one of the better tools that we have in supervision, that stress testing also continues to be sufficiently agile and nimble. Now there is the difference between what we call top-down stress test and bottom-up stress test. And the process in Europe around, let's say, the bottom-up stress test is one that I could have mentioned in my speech also when I talked about examples for simplification. Because I do believe that that sort of whole structure has become so complex, so time-consuming, that the results of the stress test are there probably at the moment in which banks are already concerned about another shock than the one that was simulated in the stress test. So I think we should probably do more top-down type stress tests because they can be adjusted more quickly, more nimbly to the changes in reality. And then I would also say, traditionally we focused on the banks, but I think what the Bank of England has done in terms of a systemic liquidity stress test for the non-banking sector and what the ECB has also announced it is about to start, I think is increasingly important given that non-banks now constitute roughly half of all financial intermediation worldwide and clearly are becoming an increasing part of the financial system. That's of course a different type of stress, as the concept of resilience is different in non-banks from banks. Banks more focused on capital, non-banks more focused on liquidity mismatches, etc. But I do think that stress testing will become equally important in NBFI than in the banks.
Yeah, definitely. So we have 5 minutes left, and I would like to devote these 5 minutes on another relevant topic, which is, you mentioned that in your intervention, the digital transformation and the effects that this may have on from a financial stability perspective. All the challenges coming from technological innovations, because new technologies are transforming the provision of banking services through different channels. We have, of course, artificial intelligence and machine learning, cloud computing. I would like to have the opportunity to ask you about artificial intelligence. But first, Governor Knott, there's also a transformation in the structure of markets, thanks to the distributed ledger technology, the DeFi. We have also various forms of crypto assets. You particularly mentioned stable coins. But I would like if you could elaborate a little bit more on this particular segment of the crypto ecosystem and the challenges that may come, or what are the greatest risks that you see in the stable coins coming from the stablecoin sector?
Yeah, I think you correctly pointed out the emphasis on stablecoins because before going there, I mean, there's a distinction between stablecoins and, let's say, other crypto assets and markets. The other crypto assets are, in essence, very risky investments, but we know how to deal with them, right? I mean, people are free to make choices. We don't prohibit people from going to casinos. So why should we prohibit people from going into crypto? As long as they understand the risks. So the regulatory framework is then very much focused on investor protection, on sort of having the governance, separation of funds, separation of duties, the governance structures, etc. Stablecoins is actually more tricky because it has the pretense of stability through a mechanism, a pegging mechanism with underlying assets. But of course, where there is the pretense of stability, there is the potential risk of runs. And these runs could be very destabilizing, particularly when stablecoins were to develop into a sort of settlement mechanism for the other crypto assets, as is increasingly, I think, beginning to happen. So with stablecoins, we have to be very, very sharp on the regulation. The concept behind the stablecoin is not all that different from a money market fund. It's, in essence, you're entitled to a claim on the underlying assets. So within the FSB, we then say, okay, same activity, same risk, same regulation. So we should make sure that at least the regulatory certainty that you get in that area is comparable to the certainty that you have in comparable economic activities. Which means that we have to be really, really tough on sort of being able to confirm that the underlying assets are indeed there and that the settlement mechanism is there, the stabilization mechanism is there, so that the stablecoins indeed can provide the stability that they pretend. Now, whether that is already the case with the existing stablecoins, I have my reservations here and there. And also the fact that these things are cross-border, which also means that some countries are, they run the risk that their sort of domestic payment system is over-flooded by stablecoins coming from different jurisdictions. So not only do we need a good and adequate regulatory framework, we also need global coverage of this regulatory framework. Because nowadays you can take a server under your arm to any place in the world and start issuing digital assets. So we have to make sure that wherever the digital asset is issued, that the users of these assets can have a certain degree of assurance that there is these minimum recommendations are being implemented with respect to the regulation and supervision of these stable coins.
Governor, maybe you want to react to the stable coins. If not, I have a question for you on artificial intelligence, because
I think
okay,
class
perfect,
presented
because we are out of time.
Where we are, and it's complex.
Fantastic. Then just one last question on artificial intelligence. It's clear that it's expected to bring significant benefits in many areas, we know that, but it comes also with some risks and challenges associated that need to be addressed. And in Europe, in the European Union, the use of artificial intelligence is regulated by the Artificial Intelligence Act. And in Spain, particularly here, Banco de España is expected to be the authority responsible for this supervision. So my question would be, Governor, how is the Banco de España preparing to face these new responsibilities, and how do you think these new challenges should be addressed?
Okay, here there are two completely different levels. One as a market surveillance authority, and a completely different one is as practically all agents in the economy, we have to be prepared and equipped for these new technologies in order to enhance and to reap the benefits that from relying on this kind of instruments. So I think the two different levels. On supervision, I mean, it's true that I would say, unfortunately, the European regulation has segmented somewhat the market. They have done on other issues. Probably now with the new spirit, probably we would have done something different. But the reality is that it has been decided that the supervision of the use of AI models by different sectors in the economy, and in particular in the case of banks or in the case of insurance companies, will be the supervisor of the insurers. In the Spanish case, it will, in principle, be with the general supervisor. So we are the supervisors. We will be the supervisors of the use of these models for the Spanish banks. But here there is the risk of segmentation. That's the reason we need to coordinate. In spite of this regulation framework, we need to ourselves to make efforts in order to coordinate first with the supervisor at the national level, at the European level for general purpose AI models, and at the same time we need to explore ways why the ECB should be involved, at least in gathering all the information over time that we may be producing in terms of incidents or experiences. Because here, I mean, we should work collectively in order to have a vision of a single banking market. So that's as a first reflection. But okay, the fact is that we will be the market surveillance authority, particularly for what it is stated in the regulation as high-risk models, which is those models that might be used by banks in order to rank people according to some criteria for deciding whether or not, or the extent to which they get credit from them. Individuals, not firms. For firms, it's not in principle supposed to be high risk. But it's true that this taxonomy is not closed, that we have to see how these technologies are actually employed. So I would say that at a certain point in time, this taxonomy, and this is foreseen in the legislation, may change. So the kind of models that require more surveillance may change over time. So it's important overall surveillance of how the models are used in various sectors. And that's something we need to do, and we need to be equipped for that with appropriate people, but also with coordinating device with other instances. The second, and we are working on that. I mean, we are working on that. At the same time, we are working, and this is somewhat related, for our internal use of AI models. We have decided to have there are different models, but we think the best model is to have in an organization a critical mass of people working horizontally in how to use it in the various functions of the bank. When we have examined this issue internally, we have realized that practically all the functions of the bank can benefit in the future, will benefit in the future for the use of these instruments in different directions. So, but for that to happen, instead of segmented way of doing that in different departments. We have created a center what we have labeled as Center for Experimentation and Development of Technologies, with particular focus on AI, that will be located in Barcelona, and in order to try to have the human capital that can be developed there because of being the major Spanish technological center. And we have already, we have, I think, 25 openings now for AI engineers and data scientists to work together horizontally in the bank. And that's important, we feel that linked to the European project of the so-called AI factories, and with one of the factories would be in finance, we can work together also with the Spanish banking system in order for them to experiment in a sort of sandbox. It's not exactly a sandbox, but in the type of sandbox environment to try their models in experimental way in that factory, and we will be also involved. And I think we see benefits in that they do it also in collaboration with the surveillance authority. I mean, this may save time for the future. So that's the way we envisage to operate in this area.
Perfect. Definitely, it's a quite changing environment and needs this flexibility to adapt. So we have reached the end of this session. I don't know if you would like to add something, any of you, but if not, again, it's been a pleasure having you both here with us. Thank you very much for these insightful and fruitful discussions. And I think that we have a break for a coffee break until 10:30. Thank you. Thank you, both of you.
Thank you.